Welcome to Byte-Sized Tech, where we blend casual conversations with insightful discussions on the latest in technology and gadgets. Today, we've got a fascinating array of tech giants, innovative startups, and global economic shifts on our radar. From Apple's strategic moves in China to the evolving partnership between Microsoft and OpenAI, and how AI is revolutionizing everything from healthcare to personal finance, we're going to unpack some truly compelling stories.
Yeah, it's a busy time in tech, definitely. There are new developments constantly emerging that change how we interact with the world and manage our money, too. We'll be looking at how these big names are navigating some pretty fierce competition, leveraging cutting-edge AI, and even, shaping international relations.
Yeah.
Get ready to connect some dots you might not have considered.
Okay, let's jump right in. Let's start with a big headline. Apple closing a retail store in China. First time ever, right? On the surface, you might think, is this a huge deal?
Well, it's interesting. What's really fascinating here is understanding the context. While it is just one specific mall where actually other U.S. retailers like Coach and Hugo Boss have also left, China remains this colossal market for Apple. You can't forget that. But the bigger picture does reveal sales declines. And there are a few factors driving that.
Okay, like what?
So first, the domestic economy there. You've got deflationary pressures, the sort of lingering effects of tariffs. These are impacting demand in China, where, exports are such a huge part of their economy.
Right.
And then there's the local competition. Names like Huawei, Oppo, Vivo, these are real contenders now. People are actively seeking alternatives to Apple.
Why is that? Just better phones or?
It's partly that, but also it's tied into the U.S.-China relations. There's definitely governmental pressure, subtle or not, to support domestic brands.
Ah, okay. So it's not just about one store closing. It's really a reflection of a much larger competitive and economic landscape. But switching gears slightly for Apple, what's this news about their credit card business?
Yeah, that's another interesting angle. It raises this important question. What's next for Apple's services push? So JP Morgan is apparently now the front runner to take over Apple's credit card business. Remember, Goldman Sachs tried this and it kind of fizzled out for them.
Right, and I remember that.
For JP Morgan, though, this is a pretty significant opportunity. They could push their financial services products to this vast legion of Apple customers. Services are just so crucial for Apple's future growth beyond the hardware.
Makes sense.
Right.
Okay, let's turn to another tech giant that's always in motion, Microsoft and OpenAI. We're hearing talks are progressing to change their partnership terms. What's really at stake here?
Right. So if we connect this to the bigger picture, Microsoft poured massive investment into OpenAI early on. That gave them critical access to OpenAI's tech for integration into Microsoft products like Azure or Office. But there was always this cliff provision people talked about, a concern that if OpenAI actually achieved artificial general intelligence AGI, Microsoft might, lose access to that really advanced tech.
Ah, okay. So these ongoing negotiations are basically about avoiding that potential cliff, making sure Microsoft stays in the loop.
Exactly. Sources are indicating the talks are positive, and they're aimed at ensuring Microsoft retains access even if AGI is reached. That's key for Microsoft. Now, on OpenAI's side, they seem to want to alter their corporate charter.
Why is that?
Well, it seems to be about getting greater flexibility, maybe the ability to raise even more capital down the line. And you're hearing that SoftBank is applying some pressure for this restructure to happen by year end, so there's some urgency.
Right. And it sounds like OpenAI feels like they deserve a bigger piece of the pie now, too, given their success.
That's definitely part of it. I mean, Microsoft struck a really good deal, as people say, back in 2019. Now OpenAI sees their immense value, their valuation is huge, and they want a larger revenue share. It makes sense.
And this partnership, it's really propelled Microsoft, hasn't it?
Oh, absolutely. It's given Microsoft this powerful tech-forward position. They were among the first to really capitalize on this whole AI cycle. And look at their Azure cloud business. It's propelled it to, a massive $80 billion run rate with over 30% growth. That's staggering.
$80 billion. That's an incredible run rate.
Yeah.
But, you hear about the cost. Does this enormous capital expenditure for all the AI infrastructure actually make sense? Is it paying off?
That's a really important question people are asking. The spending is significant. Some estimates put it roughly dollar for dollar against the revenue generated, at least initially. But Microsoft's diversified business think Office 365, their traditional server stuff, throws off so much cash they can afford to fund this.
Sure.
And it's widely seen as the right trade-off strategically, especially as AI moves beyond just the basic infrastructure and starts to really impact platforms and applications. You see it with products like Microsoft Office Copilot. It's rapidly improving, getting more customized for enterprise users.
Yeah.
So it's really no wonder Microsoft is now the world's second most valuable company. They're riding this wave.
Okay, so from the giants, let's pivot to a fascinating startup that's making waves. Ambient Healthcare. Backed by OpenAI, interestingly enough, they just raised, what, $243 million? Valuing them at $1.25 billion. Where does AI really fit into healthcare? We hear a lot of hype, but what's the reality?
Yeah, the promise of AI in healthcare, especially for handling all the administrative stuff that's been talked about for years, Ambience Healthcare seems to be one of the companies truly delivering on this. They're focused on liberating clinicians, doctors, nurses from that mountain of paperwork and admin burden.
Okay.
So they can actually focus on the patients, which is, the whole point.
How does it actually work, though? Give us the aha moment. What does it do day to day?
Okay, imagine this. Before a patient even walks into the room, the system summarizes all the relevant context for the clinician history, meds, recent labs, everything. Then, during the visit, it listens quietly in the background. It's automatically generating the necessary documentation for the clinician afterwards. It even creates a summary for the patient and their family, which is great.
Wow.
And then after the visit, it helps automate billing, coding, prior authorization workflows, basically all the tedious stuff that helps the health system actually get paid. It was like an end-to-end assistant.
That sounds incredibly efficient.
Mhm.
So what makes their approach unique, especially with, powerful general AI like OpenAI also out there?
Their core competence, they say, is building clinical-grade and compliance-grade foundation models specifically for healthcare and medicine, meaning these AI models are trained on vast medical data sets and meet really rigorous accuracy standards for clinical use, and they meet all the privacy and regulatory rules like TAIA. There's apparently a massive gap between a general-purpose AI and a model that truly understands the nuances of medicine across like 100+ specialties. Think primary care versus, say, a super specialized oncologist.
Yeah.
And the adoption rates seem to back this up. At Cleveland Clinic, for example, over 80% of their clinicians are reportedly using Ambience's tech daily for over 70% of visits. That's like 2 to 3 times more usage than alternative solutions.
That's impressive adoption.
It really is. And it's crucial because as a country, we're facing this projected shortage of over 100,000 healthcare workers. Plus, we spend something like $1 trillion on administrative waste in healthcare.
$1 trillion. Yeah.
So AI, if it's done responsibly, with privacy and governance built in, it offers this massive opportunity to overhaul the system.
Okay, shifting gears again, let's talk personal finance and SoFi. They're seeing strong growth in their fee-based revenues, and their CEO talks about appealing to overachievers. What's their secret sauce there?
So FOMA's made a very conscious effort to diversify away from just lending into these capital-light, fee-based revenue streams, and it's working. Those now account for about 44% of their revenue, with pretty strong operating margins. This includes fees from their loan platform, their money accounts, brokerage, credit cards.
And who are these overachievers they keep talking about? How are they different from what, say, maybe PayPal is seeing in the broader consumer market?
Right. So unlike some competitors who might be seeing some cracks in consumer strength generally, SoFi says they're seeing really strong trends among their target audience. These are people who are actively looking to save, invest, achieve longer-term ambitions. They're financially focused.
Okay.
SoFi helps them lower debt, for instance, by refinancing high-interest credit card debt, often like 24, 30% APR into their personal loans, which might be more like 12, 13%. That's a big saving.
Yeah, definitely.
They also offer attractive savings rates. I think it's like 3.8% if you have direct deposit, and a whole range of investment opportunities, fractional shares, ETFs, even IPO access and private equity sometimes.
So they're really leaning into technology to offer all this. Is AI a major driver for them too?
Oh, absolutely. Their CEO is quite vocal about it. He sees blockchain, crypto, and AI as these two unprecedented technology supercycles that are providing a significant tailwind for them. AI is already helping them behind the scenes, in the back office, resolving customer disputes faster, flagging suspicious activity more effectively. And on the consumer-facing side, they're developing tools like Cash Coach, which lets you see all your cash across different accounts in one place. So While the full impact of AI might not be like completely baked into their results yet, they clearly see it as being on the cusp of revolutionizing financial services, making money movement faster, cheaper, and safer.
Okay, so we've touched on companies navigating their own paths, but let's zoom out again to the global stage. We keep hearing about U.S.-China trade talks, and technology seems right at the center. It feels like a high-stakes tech chess game. What's the core of this race between the two nations?
Yeah, it really is a high-stakes game. Fundamentally, this whole discussion boils down to American security, prosperity, and leadership. And it's playing out across key areas: AI, manufacturing, energy. You've got China, which has built this absolutely massive manufacturing economy, and then the U.S., which is a huge consumer economy.
Right.
The core issue is the trade imbalance. The U.S. consumes roughly $300 billion more in goods from China than China buys from the U.S. And that imbalance becomes a major vulnerability when you're relying on, frankly, an adversary for nationally critical items.
Like what specifically?
Things like rare earth magnets essential for electronics and defense, batteries, key pharmaceutical ingredients, and crucially, the ability to manufacture advanced semiconductor chips.
So the goal for the U.S. then is to try and rebalance that trade relationship, reduce that dependency.
Precisely. It's about creating incentives for the U.S. to actually build these crucial things at home, or at least with trusted allies, rather than relying so heavily on China. Take rare earth metals, for instance. Yeah, the process can be dirty, but the argument is the U.S. can incentivize cleaner, more effective domestic production compared to China, where environmental concerns are often, well, less of a priority. It's about supply chain security.
Okay, so where does the leverage lie in these negotiations, especially around technology? Who holds the cards?
The U.S. actually has significant leverage here. China deeply values access to U.S. chip technology and, maybe even more importantly, access to the huge U.S. consumer market. So pretty much everything is on the table in these talks. Issues like TikTok's future, strict export controls on advanced chips from companies like NVIDIA. It's all interconnected. The ultimate goal for the U.S. administration is to strike a deal that ensures greater American security and prosperity in the long run.
And is China just accepting this reliance? Or are they pushing for their own tech stack?
Oh, they're definitely pushing for independence. Xi Jinping has publicly stated a clear desire for an independent, controllable AI hardware and software foundational system. Essentially, a complete Chinese tech stack from top to bottom.
Right.
Which, from a U.S. perspective, makes deals and alliances with partners like the EU and Japan even more vital. Because together, these democratic allies represent maybe 60–70% of global GDP. That's a strong base to deploy American and allied technologies as the sort of backbone of the free world's tech infrastructure.
So the U.S. is trying to build a counterweight.
Exactly. You hear about the administration trying to put together exportable AI packages, basically trying to help other countries adopt U.S. and allied tech instead of Chinese tech. It's a clear geopolitical strategy playing out in the tech sphere.
Fascinating stuff. Okay, let's round out our discussion with Spotify. They recently reported earnings that seemed to disappoint investors. Shares dropped quite a bit. What's the story there? Is the core streaming business in trouble?
You know, in some ways, Spotify is kind of a victim of its own success, which is an odd thing to say about disappointing earnings, right?
How so?
Well, their stock had been doing so well that they actually had to pay out significantly more than anticipated in employee payroll taxes tied to stock compensation. That's what led to the reported loss in earnings per share. So it was more of a financial mechanic and accounting thing rather than a sign of fundamental problems with their core streaming business or user growth.
Ah, okay. So it's not like people are suddenly leaving Spotify in droves.
No, not at all. In fact, Spotify continues to add subscribers and active users every single quarter. That's actually quite remarkable given how competitive the streaming market is. The real strategic challenge for them, it seems, is figuring out what their next successful vertical is going to be beyond just audio streaming.
What do you mean by vertical?
Like a new business line or major feature area. They've been, for example, rethinking their big push into advertising. Their head of advertising actually stepped down recently, which might suggest a bit of a pivot there.
And they seem to be making a pretty concentrated push into video now, right?
Yes, definitely. That seems to be the current focus. On their earnings call, one of the co-presidents called video an exciting opportunity. Though, interestingly, he also said it wasn't necessarily a necessary one.
What do you make of that?
It suggests it's a strategic choice, maybe to increase engagement, rather than something they feel they have to do to survive. They've really doubled down on video podcasts, actively trying to recruit more video creators. They're still missing some of the really huge names in video podcasting, but they seem persistent. They clearly see value there.
So where do they see their growth coming from in the long term, then? If advertising is maybe being rethought, and video is exciting but not necessary.
It looks like their strategy is kind of twofold. First, keep expanding in developing markets where there's still a lot of potential user growth. And second, try to get existing users to spend more time on the platform. And that's where things like incentivizing video consumption come in. They apparently compensate creators based on watch time, not just ad views, and also up-leveling users to different subscription tiers, maybe through offerings like audiobooks. So yeah, despite that short-term earnings hiccup related to taxes, they seem to remain pretty bullish on their long-term product roadmap and user growth. They're trying to become more than just music.
Wow. What an incredible landscape of innovation, challenges, and strategic shifts we've explored today across the tech world. From Apple's global maneuvers to the deep integration of AI in health and finance, and that ongoing dance between tech giants and nations, it's really clear that the digital fabric of our lives is constantly being rewoven.
Indeed, it really is. The insights we talked about show us not just what's happening right now, but they offer, I think, a glimpse into the underlying forces shaping our future. Everything from how we consume content to how we manage our health and our finances. The speed of change is just something else.
Thanks for tuning in to Byte-Sized Tech. If you enjoyed the episode, like, comment, share, and subscribe for more fun tech discussions. And as you go about your day, perhaps consider how much of the technology you rely on is shaping the bigger picture of global competition and innovation without you even realizing it.